last week's news that the UK had moved into, quote, technical recession, unquote, with the release of a contraction in Q4 GDP, well, it hit headlines well beyond the financial press. But we think the numbers mark the low point in the UK economic outlook and expect a significant upturn from here. We look at the evidence and examine the implications for UK markets if our judgment is correct. Now, the first point to note is that the term technical recession merely refers to 2 consecutive quarters of negative growth in GDP. The UK does not have a proper system for determining recession, unlike the US, where there's a committee of economists who opine on the matter. If we did, I doubt that they would call this a recession. Unemployment's too low and employment is growing, and you don't get that in a recession. Yes, growth has been sluggish here in the UK, but it's not a recession, in my view. More important, though, is the immediate economic outlook, which is for a significant pickup in growth. Weak consumer spending, which has been a major factor behind the sluggish UK growth in 2023, that is set to recover in 2024. Real incomes are rising, bolstered by falling energy prices, lower taxes. Consumer confidence, that has already picked up markedly. Mortgage rates have fallen significantly from their highs last summer, and there are clear signs of a recovery in the housing market. Rightmove, their house prices rose strongly month on month in both January and February. The dark days of 2022 and early 2023, when household energy bills and inflation were soaring, well, they're a thing of the past. The wage price spiral is going into reverse. And despite all the gloomy talk in the media, household balance sheets are actually in pretty good shape. Consumers have the wherewithal to spend. We also had some very good news on UK inflation last week, with a significant decline in the numbers across the board, and that confounded more pessimistic expectations. But despite this, don't expect the Bank of England to start cutting interest rates anytime soon. Yes, price inflation is falling fast, but it remains well above target, and wage inflation is still far too high. The 9.8% rise in the minimum wage due to take effect in April, well, that's going to only add to the Bank of England's concern. Moreover, the forecasters at the Bank of England have had a pretty tough time of it. They failed to anticipate the rise, failed to anticipate the fall in inflation, whilst their projections in the real economy have also been wide of the mark. So, the Bank of England committee will be most reluctant to base any decisions on a forecast, and with unemployment still so low, they don't have to. They can be patient. Now, financial markets are pricing in almost 1% cuts in total in bank rate over the next 12 months. Now, that is admittedly significantly less than they were expecting a month ago, but it's still substantial. And we think rates will fall that far and go down further eventually, but expect the Bank of England to be very cautious before making the first cut. Central banks in the US and Europe are likely to be cautious too, but I reckon they will move first. They're further along the disinflation process. And if that is the case, and we see stronger growth, lower inflation, and rates remaining high in the UK, sterling should benefit against both the US dollar and the euro. Now let's be clear, I'm not forecasting a boom in the UK, but growth does look set to improve in both absolute terms and relative to the US and Europe. So, if the UK economy is looking better, can we expect to pick up in the UK stock market? Well, not necessarily. Remember that the FTSE 100 is dominated by global companies who earn their profits abroad, overseas, in dollars, and a stronger sterling does them no favours. As smaller companies, they should fare better as they tend to be more domestically orientated. But the biggest single sector in the FTSE 250 index, that's companies just outside the FTSE 100, smaller companies, well, the biggest sector there consists of UK funds who invest all over the world. Better growth, a stronger currency, and eventually lower interest rates are all good news. And we are positive about the outlook for equities generally. We just don't think the UK market itself will particularly outperform. Until next week, goodbye from me.